All right, so we're doing a new segment. We've got Chad Lafferty at CBRE on the lending side, providing some insight today, doing a sample underwriting on one of our listings on Priest, the Caliber Collision and Carrie's Car Care. Enjoy, and let us know if you have any questions.
Right now, what's going on, as you can see kind of with the rates and the CMBS stuff, that's blown out because of the spreads and just because of the way everything's pricing. So typically, your most typical CMBS debt you would normally get would be like a 10-year, but because of the way that the spreads and everything else is blown out on that, the actual more competitive product right now is like a 7-year, but you're still like close to 7%. And you have, it's, depending on the loan, you're usually in defeasance, so you're basically in it for the long haul. And if anything happens with regards to the property, you drop through any of like what you call like your debt service coverage covenants, you're automatically in cash management and cash sweep, so you as an owner are not collecting any cash whatsoever. It just goes straight to the servicer. Yeah, so it's
we're getting back to those days again.
Well, no, because like we met with the CMBS lender yesterday, and they are hurting. Their volume has dropped significantly just because of the fact that like one, all their spreads blown out, but just hasn't been a very competitive product.
Yeah.
For such a long time.
So that's just for CMBS, right? Because you have to submit reports. I don't know if it's quarterly.
Yeah, so you put in like quarterly financials. So that's the hard part. It's like to get off out of cash management. It's like usually it's like 2 quarters of like you're going through your meeting your debt service covenants. So like for instance, let's do this.
So many Excel files.
Oh, I know. I've been trying to like. Because like usually all of our like Excel analysis stuff is set up for multifamily, so I've had to like rebuild
for like retail, industrial, or
yeah.
That's so funny.
I would imagine in your area of the world you live in, Microsoft Excel.
A little bit. Like most of the stuff I've picked up, just getting better. Not like I would rate myself like a 5 out of 10 or a 6 out of 10.
Oh really?
And there's definitely people that are just like way blow me away all the time.
Wizards.
Yeah. I follow a couple like the Excel tips on some like the Instagram accounts and stuff, and I'm always every day I'm just like, oh, I didn't know that. All right, so I did just a quick underwrite of like your Priest deal.
Okay.
So one of the things. I'm just gonna do like a high level stuff going on right here.
So it's a pretty good deal, right?
I mean, honestly, I like the deal. The problem is like, whatever, just back off.
I hate that happens.
The problem is like right now what we're experiencing because cap rates have not grown as quickly as the interest rates is that you really can't get any leverage.
Yep.
So this right here, I just did like I set up because I had to do this for our other brokers too, just to kind of show the difference. And so like for instance, with you guys, normally, I was like full triple net, I'm just assuming.
Yeah.
The way the lender looks at this, essentially, is they're going to underwrite it like this. So the lender looks at it as is, if I took this property back today, what expenses am I going to incur? And I don't want to incur anything out of pocket.
Right.
And so for them, they automatically underwrite general vacancy. Here I just put 5%. Typically, it's going to be whatever market is, or 5%, kind of whatever. So like, or I'm sorry, it's actual. So like for instance, I didn't have a chance to look up this sub-market, but like if the sub-market's 8%, we're gonna have to underwrite 8%.
Yeah, this one's a little bit lower, probably around 3.
They're gonna underwrite a minimum of 5% no matter what.
Okay.
And even
so
on even on single tenant properties, they usually underwrite a 5% vacancy, which for them is just in their mind more of a frictional vacancy. So for instance, if they had to replace that tenant for any particular reason, that would help kind of incur some of that.
TIs, commissions, etc. Gotcha.
They're gonna underwrite a management fee here. I just did 3% because this one's pretty simple. And I didn't have any leases, so I'm assuming they're all full triple net. They'll probably reimburse most of the stuff, which I can add back in.
Which is nice.
Yeah, like insurance, I just took a guess, like a 20 cents. Multifamily is usually like 40 cents a square foot. And then here, the real estate taxes, I just put actual, but with a sale, it's probably gonna be 5% higher than that. Just we can only max increase real estate taxes 5% on new purchases.
Interesting.
And then another thing that we take out is reserves. Here, I usually break these down so you can kind of see. So like the difference between, like this is a bank or credit union, and then there's a life company is in the middle, and then CMBS is on the left, or on the right, I'm sorry.
Am I blocking any of this, Anna, by the way?
Oh. So you can see the difference in the reserves taking out with regards to how much they need.
Yeah.
So a lot of like banks and credit unions are a little bit smaller, that's 25 cents. The life insurance companies are 50 cents, and then typically right now it's anywhere from 75 cents to $1.50.
Holy cow.
Yeah, so that's the thing that's also killing a lot of these deals is the fact that the NOI that the lenders are usually underwriting to is less than what you're actually collecting as an investor or an owner.
Right.
Interesting.
So that affects a lot of your proceeds as well.
Yeah.
So for here,
And that's crazy too, because wasn't Lifeco, their interest it's traditionally been better than some of the other deals, right?
yeah, it just depends because right now most of the life insurance companies are pricing off of the treasuries.
Yeah.
So when treasuries blow out, they haven't really lowered their spreads as much because most of the time the way that the life insurance companies work is they're just trying to return capital in the most efficient or best way that they can. So right now they can go buy corporate bonds with less risk and more liquidity for a better return than most of the time they can get, or a little bit less of a return than they can get on real estate. So
Makes sense.
so like a lot of the spreads right now on life insurance is like anywhere from like 170 to 200, which I think we called out right here.
Interesting.
And so there's definitely ways to structure deals right now to be able to get them done. It's just the leverage on it is very difficult to get on stuff. And it's mostly just because the cap rates are still lower, so much lower than where the interest rates are.
Right.
And so one of the things I always try to like communicate with Mark and stuff is saying like, hey, just to let you know, here's the way the lender is gonna look at your P&L, and they're gonna still take out a couple of those, so that NOI is gonna be less than the borrowers. So like a lot of times people will just be like, oh, I can get like 75% leverage on this. It's like,
Yeah. Not gonna happen.
maybe.
Yeah.
It just depends.
Yeah.
So
I've got a question for you too. A lot of the times right now, clients are bringing up non-recourse as obviously something that's beneficial for them, and the rates are different depending whether it's recourse or non-recourse debt. Can you talk a little bit about that? And
Yeah.
explain why someone would want that versus not?
So, I mean, this gets kind of back into, I mean, there's a lot of different factors that go into this. One, non-recourse is great because most of the time the way it's set up is if anything happens, the lender just takes back the property. You're not responsible for the remaining loan balance that's available, that's there.
Right.
Whereas recourse, whatever that remaining loan balance is, even if you get the property back to the lender, you're still responsible for that remaining loan balance. So that's a big thing there. Another thing, and you'll probably have to check with an accountant on this,
Yeah.
but non-recourse loans don't show up as a liability on your balance sheet. So for people to be able to kind of go through, because it's non-recourse, basically,
Yeah.
you just
Yeah.
give the keys back, right?
Which is what happened a lot in 07, 08, right?
A little bit.
The people were
It was
just
a-
giving
it
the
was a
keys
mixture.
back, and that was it.
Well, I mean, yeah, at a certain point, like
Yeah.
if I own an office building in 08 or whatever, I'm just giving the
Yeah.
keys back and I'm just going to be responsible. I'm not going to try to keep sinking money into it.
Yeah. That's the best case scenario for them at that time.
Yeah, I mean, it's for all the properties.
Yeah.
So with regards to that, it's also a way that when you're structuring deals with regards to investors or an equity partner, typically the way that the recourse loans are structured with regards to the language is anyone with 20% or more ownership has to guarantee the loan
Okay.
in proportion to your ownership percentage. So if I come in and Mark and I want to go on a deal and Mark just wants to invest in my deal, he doesn't want to be the recourse portion of it, even if he's going to be like 60% of the deal. right? He just wants to be an investor. So I'm going to try to target a non-recourse loan because then there's no liability for him.
Gotcha. But you would still have recourse on that situation?
Or on a non-recourse loan? Or on a recourse loan?
On a recourse loan.
Yeah.
Yeah.
Anyone with 20% or more ownership has recourse.
Okay.
So if you're 19.99.
Yeah.
The bank's going to round up.
Yeah.
People have tried that.
Interesting. I would imagine
Yeah.
so.
We used to do a bunch of SBA loans and people used to try to like skirt it, and so like we'd be like, hey, it's 18.5%, and the lenders after a while are just like, yeah, he's on.
Yeah. That's close enough.
Yeah. So
Interesting.
this is one thing I wanted to kind of show you too, because this is one of our little analysis we do. I kind of hit a little bit of the rows to make it easier.
True.
It's mostly set up for our multifamily, so we haven't set it up for
Units.
for the other stuff. But like
You're
the
good.
important thing is to look at these boxes over to the right. So this is your debt service coverage ratio or your DCR, and the one below that is your debt yield. These are pretty much the two metrics that the lenders are going to take a look at to kind of like gauge if your loan is in kind of it's more of like how much proceeds you can get.
Yeah.
So for instance, on this one, I just did a bank 5-year fixed at our NOI from our bank underwrite on the other side, and I just did a 175 spread over the 5-year, which was yesterday. So you can see it's a 588 rate.
Yeah.
But where our governing factor is here is we're already at the 125 DSCR, so we can't get any higher on proceeds.
Interesting.
Now, what's interesting is like this is on a 25-year AM. If you can go to like some credit unions and stuff that can get you a 30-year AM, then all of a sudden, this is.
Yeah, but you were right. The one that was sent and the one that you sent me and Jason, that it showed up with 22.
Kinda cool.
Look at those formulas.
You can see how you get a little bit extra proceeds over here at 4.2 instead of the 4 million just by getting the amortization up.
Mm-hmm.
But the trade-off there is that your loan balance is not getting paid down as aggressively.
Right.
So there's a couple different ways that lenders will try to structure loans depending on the risk factor. So a lot of life insurance companies with like either single tenant, if they actually want to look at those, or like multi-tenant retail or multi-tenant office or some of that stuff.
Yeah.
With smaller rent rolls, they'll usually try to put together a 25-year AM or even a 20-year AM, depending on how risk averse they are, because they want to amortize that loan balance down as low as possible, so at the end of the term, they don't have as much basically that they have to deal with if anything bad goes on. And so like for instance with treasuries here, we're at let's just say it's a 175 spread, right? We're already at our 125 coverage, which is max. If that treasury moves, let's say that treasury moves to 420, now our proceeds just got cut even more.
Holy cow.
Yeah.
So like, let's just put that there. Now we're at 595, now we're at 3.98. We just lost 20 grand in proceeds just based on a 20 bip movement or 15 bip movement on the treasuries. So that's why 7 bip movement. So it's like, it's been really tough to put deals together because certain lenders, you can't lock your rate, which is like one of the issues with CMBS right now.
Yeah.
Is that you're literally not locking rate until you're getting pretty close to close.
Is
Wow,
it just like
that's-
even like past like loan committee?
Mm-hmm.
Wow.
So that brings a lot of uncertainty right now when obviously rates are going up fairly quickly
Yeah,
to
it's
not
like-
have a lock in that rate.
Now banks and credit unions and stuff
Yeah.
do lock a little earlier. So what they'll do is when you sign up, so initially how the process works is we'll submit everything into the lender. The lender's gonna do an initial underwrite. They're gonna pre-flight it up through any of the committee,
Yeah.
and then they're gonna come back and say, okay, here's the structure that we like, here's the interest rate we can get to, and they'll outline it in a term sheet, which is usually a couple pages that outlines a rough loan structure.
Right.
If everything's acceptable, the borrower will sign it and then put together a good faith deposit of usually 1%, which covers third-party reports as well as any other kind of like interim bank fees that they're going to incur. Most of the time at that point, that's when they'll lock the rate in, but it's usually only for like 30 or 60 days.
Interesting.
Okay.
That makes sense.
So with everything going on right now, are you seeing most people leaning towards a shorter term loan or longer term?
It's tough. Right now, like most of the typical bank terms right now are going to be an initial 10-year term, but they're usually structured as like a 5 and a 5. So meaning it's going to be fixed for 5 years, and then whatever the spread is, so here, right, it's 175. In 5 years, whatever that 5-year treasury is, or whatever index they're using,
Yeah.
plus that spread, that's what your new rate's going to be. And then it's going to be fixed for 5 years for that
Okay.
10-year term. Life insurance companies are typically a 10-year fixed. They'll do a little 7-year fixed, but it just depends on really how much money they want to get out shorter term rather than longer term. They typically like to have longer term stuff.
Yeah.
So a lot of life
Right.
insurance companies, I mean, you can get 15, 20-year fixed on some of this stuff, which is great, but you have to, you're going to be in that. Your prepayment penalty is going to show.
Exactly. But I guess on the flip side, you're seeing a little bit more cash flow throughout that 15 years as well, right?
Yeah, because typically the life insurance companies were pretty aggressive with their spreads, but that's back in the treasuries. I mean, we were doing deals. I remember it's like maybe like a year and a half ago. Actually, it was probably 2 years ago. We had deals. We had a couple deals we locked in. A borrower locked in for 10 years. It was sub 3%.
Jeez.
Wow.
Yeah,
Yeah. Are we ever
There's a
going to see
treasury.
that again?
and maybe who knows?
I mean, what are your thoughts with, and Lane and I were kind of just floating this idea like the other day, with how the rates are changing. I mean, is it going to be more of a scenario where assumable debt is really going to be coming into play for acquisitions? And I guess how is that going to factor in as well?
So that's something that it's a tricky situation because one, the note has to be able to be assumed. So that's something the lender
Yeah.
has to be okay with. And then two, the borrower still has to go through a qualification process with
Exactly.
the lender to
And
qualify.
same kind of credit, same kind of
Yeah.
net worth.
A little bit is what
Give
they're
or
trying to
take.
target.
Yeah.
There's a little leeway here and there because it really just depends. The problem with a lot of like the assumable debt that's going in is that typically the real estate values have gotten higher from where people initially took out their loan.
Exactly.
Now that might be a little bit different with cap rates rising, so the values
Yeah.
might be coming back closer towards like where initially that loan balance works. But
Mhm.
right now it's like, look, I just did your $9.35 million purchase price, and we're only at like a 42% leverage
Yeah.
Yeah.
because that's all we can get to.
Which is kind of what we were
Proceeds.
expecting with, lower leverage as well.
Yeah, and I think this is like a, based on my NOI, it's like a 409 cap.
Yeah.
So I mean, you guys are higher obviously because you guys have a higher NOI, but based on like all the expenses. And there's
Yeah.
investors that are going to underwrite a similar way that we are because they know that's what's going to govern their loan proceeds.
Correct.
But yeah, I mean, there's a lot involved. I would say right now, the tough part with regards to what investors are facing and buyers is that you can't get any leverage.
Mm-hmm.
Rates are moving very quickly, and there's a perception that cap rates are going to go up, so values are going to come down. So
Right.
why am I going to try to buy something today where maybe I can look at it 6 months from now, and then the cap rate will be 50, maybe 75 bips higher?
Yeah, I mean, we're talking to a lot of guys that they're already expecting those the days of the 7% cap rates to come back. So,
Yeah.
I mean, just with where rates are going. So,
Yeah. And then obviously too, as rates continue to go up, there's a lot of people thinking that at some point they'll come back down to the levels they once were just a year, 6 months ago. But
yeah,
obviously it's probably a little bit a longer life cycle than they're expecting, right?
Yeah, I mean,
we'll see.
any of the feedback that we've gotten kind of internally from some of our economists or people that follow the Fed, any type of rate, I guess, either pause or kind of like pullback from the Fed would happen in like 2 years, maybe. And they would
Yeah.
be like, and it's not like they're going to be like, okay, we're going to drop the borrowing rate, 200 bips now. It's like, we're going to drop the borrowing rate like 25 bips, 50 bips maybe.
Exactly.
So it's going to be like a slow
Steady.
pullback
Yeah.
right now. The problem is that right now the Fed still doesn't feel like they have control of inflation. And so that's kind of the main issue with regards to the expectations is that they're going to keep pricing in some additional bumps and so we're not through yet.
Yeah.
And so until we're kind of through with that, there's really just so much volatility in the rate market right now, and with lenders, that it's just tough.
Exactly. Yeah, I know they just came out with another report this morning showing inflation was at 8.3% year over year, which is still a long ways away from the 2% target.
Yeah.
So.
Yeah.
And so we'll see. I mean, in my view, the Fed understands that they don't really have, a lot of the inflationary factors or stuff they don't really have control over, right? Like they don't have control over the price of fuel or oil.
Yeah.
They don't have control over the price of housing right now, which is we're in a housing crisis.
Yeah.
And so that's not a short-term fix. Now they can kill off demand enough where they can try to make it so it can lessen a little bit of the burden.
Yeah.
But it still doesn't solve the problem that we're short multifamily units, so rents are going to kind of stay a little elevated.
Exactly.
That's all right.
You're good.
So, we'll see. There's a lot of risk out there right now. There's a lot of, in the commercial real estate community, there's a lot of fear right now on the office side and the office assets.
Oh my God. Yeah.
Yeah.
So it's more of not necessarily that they're all scared of the work from home. It's more of that that whole structure of how the original office setup was. It's not going to be the same, and so they don't know what is going to be needed from companies going forward. How much square footage?
Yeah.
So we know right now it feels like we're a little overbuilt on office, and so they're just going to have to get rid of some of the inventory in order for that to get a little healthy. And then how long is that period?
I mean, have you guys seen it? I mean, being kind of at the hub of the Biltmore with just like activity, in and out. I mean, your office is right on 24th and Camelback. So has, working from home still affected kind of people coming in day to day, or?
I mean, we're all back in the office.
And it's the hotel setup, but you guys kind of have like your designated areas.
Yeah, we have our designated areas, but we're all back. Like everyone's back in the office. Now it's nice because it's flexible. Like everyone like this, we're all set up to go and work from home if we need to, and you can kind of work from wherever. But it's what we're seeing and what we're hearing is that there is a growing divide between the better, well-positioned office compared to like the lesser basically poorer office, either setups or office location or older product.
It's like your B, C, D, or B minus, and then below.
Exactly, right? And people, the rental rates on that is just gonna continue to drop, and so it's like, all right, well, what happens, right?
Should be interesting to see if some of these owners start to repurpose some of these buildings, or if they're still hoping that they'll be able to find a long-term tenant.
Well, and that's going to be tough because it's like, what do you find a long-term tenant at? Is it like $8 a foot? Is it $10 a foot?
Yeah.
All the way from like 16 or $20 a foot? And it's like, can you make the numbers work at that?
It's probably not the rate they originally underwrote the deal at.
Yeah.
So.
And so we'll see. We're kind of at an inflection point with regards to, we're obviously at a housing crisis, but a lot of that's determined by a lot of zoning regulation and city ordinances with regards to height restrictions and everything you can build and can't build. Can they change some of that stuff? And then can that allow some of the older office product that's obsolete or will be obsolete to be able to be redeveloped into something that's more useful?
The whole NIMBY, not my backyard.
Yeah. But we're starting to see that change over in California.
Yeah.
I'm not sure if you saw some of the stuff in Santa Monica.
Well, I mean, it's gonna have to. They've just been short on supply for as long as I can remember.
Yeah. Well,
It's crazy.
There's stories right in Santa Monica now. They have like 4,000 multifamily units that are just got recently approved because the city can't do anything because the state laws override it. Because basically the city's new plan is not in compliance, and so basically developers can go in and put together their plans, and they're just automatically kind of going to get approved if they have a certain portion of it that's already affordable that meets what the requirements are for the state.
Wow, that's going to be really interesting to see how that continues to play out.
Yeah, and so
there'll be a limit.
We'll see if that'll start trickling over into other states, and other states can sit there and say like, okay, because it's like, for instance, the build for rent. Build for rent right now is pretty big on the multifamily side. the reason that's kind of big is because you don't have to change much of the zoning with regards to the cities.
Yeah.
And so the cities are more likely to approve that type of product than they would be if you wanted to put a multifamily. But the problem is that we actually need the density and the number of units, and that build for rent doesn't necessarily achieve that.
Right.
Yeah, I mean, do you think that's going to be more popular out here where we've got urban sprawl, or people still want the density where we're closer and more infill? I feel like infill's going to be always solid no matter what.
I think it's going to be a mixture. You're always going to have some people that are going to want to have some type of like house-like,
Yeah,
I guess, living building that they're in. I don't even know how to best to describe it.
like townhome essentially.
Yeah.
Yeah.
Where maybe you don't have someone above you or below you, or you're not sharing any walls.
Exactly.
So you have a little bit of a backyard. There's going to be a market for that. Do we know how big that's going to be or where it is? Not yet. It's still growing. But there's a lot of build for rent because it's easier to develop with regards to you don't have to go through the cities and are getting held up like the multifamily developers are. So in California,
Yeah.
multifamily development, I think they were saying development timelines like 2 years
Yeah.
just to even get something through from either initial project review all the way through to maybe you can start actually breaking ground.
That's
It's
crazy.
like, how do you even underwrite rent at that point?
You can't.
Yeah,
Yeah.
the market's so unpredictable
Yeah.
over a 2-year period, especially over the last few years.
Mm-hmm.
It's-
We had a couple multifamily construction projects back at Churchill that were over in California, and it was literally that where it was like they bought some land from a church, and then part of the issue that we had was because it took so long for them to get through the development process that the land that they had appreciated so quickly that the lender didn't want to give them credit for the equity that they got from the land appreciation.
Wow.
Wow.
So it was more of like we had to go back and find another equity partner for them to
Yeah.
help because they were just like, oh, they're putting the land in as part of the equity, and the lender's like, you can't count that.
Wow.
You can't count. Well, they couldn't count all of it, so they like. But it's one of those things where, and the only reason that appreciated so much is because there was so little land available for multifamily development.
Yeah.
Yeah.
It's crazy over there. I mean, it's every time I go back to the valley, it's just always San Fernando Valley's become more infill just because people can't afford everything like over the hill, which is nuts.
Yeah.
Yeah. So obviously with all the investor capital coming into Arizona, are you still seeing as much interest in multifamily as in industrial as you once were, or where's most of the money going now?
So there's still a lot of money wanting to go after multifamily and industrial.
Yeah.
There's still money that wants to go after retail. Office, not as much anymore, which
Kind of, I mean, it makes sense.
Yeah.
um,
Especially coming out of COVID.
yeah, and so like it's there. It's just more of there's such a disconnect right now between buyers and sellers with regards to price
Yeah.
and the financing. It's so difficult to kind of try to put that together as well that it's really difficult for a buyer to come in and say, okay, I can buy this, my interest rate's going to be around here, and my purchase price is going to be around here. And without being able to do that, it's difficult for them to be able to like look and predict and be like, okay, well, here's where my returns are going to be. So there is a lot of dry powder that's out there that's waiting to go and invest. It's just more of these factors have to settle down more in order for deal flow to be able to kind of get a little bit more flowy, I guess.
Exactly.
That makes sense.
Yeah.
What was I gonna say? But, sorry, go ahead.
Could be some time though, as interest rates keep going up and sellers still want the top dollar that they thought they once could get, and obviously it's not underwriting the same as it was 3 or 4 months ago.
Yep, and I think that's one of the problems that we're seeing right now is that the time that would normally you would have in a transaction has been compressed significantly.
Mm-hmm.
So let's say you're a seller and you go out and you're as a broker go out and say, okay, we think your property is worth, let's just call it 10 million,
Yeah.
right? Well, that was 6 months ago. That property now is probably worth 6 because interest rates have moved so much in that time frame
Yeah.
that as a buyer, what I could afford 6 months ago, I can't afford now.
Exactly.
And
Yeah.
so that as affects like my purchase price. Well, sellers don't understand that. It's only been 6 months. They're not sitting there saying,
Yeah.
okay, well, my value hasn't dropped that much. There's no way.
Yeah.
They're like, economy's doing great, jobs numbers came out, we're at 3.5% unemployment.
Yeah.
Like, there's no way my value dropped that much, but it did because of the way the financing got affected. And so that's what we're seeing right now, which makes, obviously your job very difficult because, you have to communicate what's going on with the seller and then be able to kind of try to position them. Because even like, if you're trying to go to market with a deal today that you think's worth $8 million, I'd almost sit there and say like, hey, this is probably going to trade around 6.
That's crazy.
So,
I feel like it's every week we've got like a moving target that we're going back. It's like, okay, so the offer that we had, let's just say like at 7 or 7.5 million, now it's going to keep on going down because of borrowing power.
And so it's going to be curious with regards to how bad do people want to sell and what's your real number at. Because I'd almost try to sit there and say, hey, like here's where the number's at. You need to get to it, or otherwise you're going to have to hold.
Yeah.
And the borrower's going to have to be flexible and understand that, hey, the price that I think we get today then the price we end up at is going to be less than what I think that price is.
Exactly.
Right.
Yeah. And right now we're seeing a lot of the people that are selling, it's really the fear of missing out because a lot of people think that we have reached that peak in the market and prices might be going down. They won't be able to get that price that they could have got 3 months ago or even right now. And on the buy side, a lot of the buyers we're working with right now are just cash buyers who don't want to have to deal with interest rates going up and having to drop out of the deal if they can't make it pencil anymore.
Yeah, and so it's a really weird dynamic because cash buyers do have a lot of buying power right now.
Correct.
But, some of the strategies we've seen is that I'm going to go buy in cash and I'm going to come refinance later.
Exactly.
Correct?
Yeah.
Well, the problem is that the longer you wait on the financing side, the higher your interest rate's getting.
It's not getting better.
So we're trying to catch a falling knife, essentially.
And so it's one of those things where we're working with a group right now. It's going to buy in cash, and concurrently, we're going to run the financing so that they can basically close on the financing after they close on the deal to try to lock in the rate that we can get. Because in a month from now, if they wanted to go back into financing, it's probably 50, 75 bips higher than what they're going to get today.
Yeah.
Yeah.
So, and the lending environment's changing with regards to the actual attitudes with regards to these lenders. So as we get closer towards the end of the year, the lender pool shrinks because either lenders and I'll backtrack a little bit later, but the amount of lenders that are interested in trying to close deals towards the end of the year this year is less than what we normally have. And so one of the other things that we've had, and I'll go back and start talking about the lenders, is that the last basically like 3 or 4 years, lenders have been doing really well. So most of the time lenders have an allocation of funds that they need to get out every year. This year, a lot of them are ahead of that and have done more than what they were supposed to or what they wanted to do.
So they're past their point and they're just kind of relaxing fourth quarter.
Yeah, they can cherry pick what deals they want.
Gotcha.
And a lot of it right now is why am I going to lend today if I have to lend at 6% when I can wait 3 months, and if you want to do the loan, then I'm at 7%, and I can get more interest on that.
Yeah.
So, and the value is not going to be decreasing. I'm not lending on an asset that the values could drop.
Okay.
So, it's a really weird situation right now that we're in, and if you're putting deals together and you're getting deals done, bravo, because it's very difficult.
Yeah, we're seeing the same right now too.
Yeah.
Luckily, we're still at a point where a lot of our deals are closing. There's not too many falling out. Are you seeing that on your side as well, or what percentage of the deals would you say are going through versus falling out?
I would say that there has been a lot of deals falling out, mostly just because of the financing has moved so much. So they've either had to come back and try to get a little bit of a pullback on the purchase price in order to kind of match, or they've had to come in with more equity, which is difficult because you're trying to go raise equity on a deal that you're like, okay, well, we said we only needed this much, and now we need more.
Yeah.
It's just difficult. So cash buyers are going to be doing great right now.
Yeah.
But I would also say that if you're a cash buyer and you're going to go pull out debt, I'd do it sooner rather than later, because if prices keep kind of dropping as much as they are, and we get to a point where there's going to be a buying opportunity, you're going to want to have a lot of cash on the sidelines because you can pick up some deals.
Exactly.
So we've tried trying to talk to any of the clients that are all cash buyers to say like, hey, don't expend all your funds right now. I mean, there's still good deals that are going to be out there right now, but you want to save some cash or build up as much of the cash as you can because you're going to have an opportunity to buy some even more.
Yeah,
Hopefully coming up.
that makes sense.
Yeah, and especially considering interest rates will probably be higher when that time comes.
Yep.
With prices being lower, then you definitely want to save your dry powder.
Yeah, and so it's interesting dealing with life insurance companies before because the life insurance companies look at things more as a longer term than what traditional lenders do, and so they're underwriting a lot of times too with regards to values at a little bit more conservative cap rate than what is actually available in the market, and it's only because they're like, well, look, office cap rates have averaged, call it 7% over a 30-year life of whatever in this market. And that's kind of the way they look at it. And so for most of the experienced buyers and owners and operators that we've either talked to or met or done deals with, usually the way that they're looking at stuff is they're usually buying at conservative leverage of like anywhere from 45 to 60%. And they're usually trying to put long-term debt on it that's fixed for that period of time so that they can kind of really understand, okay, here's how my cash flows are going to be. And those borrowers have typically done really well in all markets because even if you lose some of the income, you're not going to be violating any of your loan covenants that are going to be in your loan agreements because you're at a lower leverage. You're usually pretty good.
Right.
You're at a higher DSCR than what usually they're underwriting. So you've got some room if there's any income interruptions. And they're just, being able to hold the assets in tough times. They're being able, if they have to lower rents, they can. If they need to do whatever they need to do to the property. And then they can sit there and they can reserve some of that cash flow for any of the capital improvements or any other things they need to do to the property to kind of maintain it.
Exactly.
Interesting.
Yeah, so you get, there's always a bunch of people that are trying to buy right now from 1031s that are trying to say, okay, here I'm going to put 75% leverage.
Yeah.
That's not available out there right now.
Yeah.
Unless you're buying a deal right now like an 8 or 9 cap, you can't get leverage. It just doesn't underwrite.
I don't know about you guys, but I'm not seeing 8 or 9 caps yet too much because obviously we're in industrial and
I think I saw one come out at an 8, but it was just like beat.
Yeah.
It was very beat. So
I saw a 12% the other day, but that was a cannabis building and obviously a little bit more risk than most other industrial deals.
yeah.
Yeah, and a lot of that cannabis stuff, it's tough because there's not a whole lot of financing options available. So you're typically stuck with like a non-bank lender, which is like, you're anywhere from maybe 8% to like 14%. And you have to pay points to the lenders. So it's expensive, but that, from what we see in that business, they're just printing money.
Exactly.
Yeah.
It's interesting.
Yeah. Any other kind of questions and stuff that you guys had?
Regarding this is kind of a wealth of knowledge, to be honest, and just like seeing like how you pick apart deals, what you're looking for, and especially with everything just going on right now, that's extremely helpful.
So like I would say like here, like we'll take a look at this right real quick. Can you still see that?
Yep.
Yep. All right. So like from a lender's perspective, on something like this, what they're also going to typically do is they're also going to typically look at where market rents are, and then they're going to underwrite to market rents. So for instance, let's say like this guy's at like $20 a foot. Yeah. Let's say market rent's like 18. They're going to underwrite him to 18 or her to $18 a foot, and then that's also going to lower your net rental income that they're actually collecting. That's a lot of times what lenders are doing because in their mind, if someone pops out for whatever particular reason and they have to release at today's rents, then they're already at a deficit because of what they were doing before. But with regards to this rent roll, typically a lot of lenders are going to, besides having to be able to overcome some of the environmental issues that they may have or environmental concerns that they may
It
have.
just
with
comes
this.
up with auto and gas.
It just
stations
always
or
comes up with auto and stuff. So having any type of clean phase ones previously, or any of the phase ones that are going to come up clean would be
Yeah.
really helpful. And then with regards to loan term and when or lease expiration, I need to fix that. I didn't think that popped up as 19.
Yeah, that's
1942. Yeah.
It goes backwards.
No, it's just Excel. They're gonna feel pretty good about this. Now, the 27 coming up with caliber corrosion because they make up 75% of the rent roll. It's gonna give some lenders a little bit of heartache. And so like some of the stuff that we like to do too is I'll put in like when they originally,
Which has been like 10, 12 years at least, which
Which-
is good.
which is helpful for a lot of lenders because
Yeah.
they're like, okay, well they've been in here a while. Chances of them renewing is pretty good because if they've
Yeah.
been in here for 10 plus years, they're doing pretty well.
Yeah, they're clearly a stable tenant.
Now, with
Yeah.
the lending environment that's going on right now too, some lenders may try to, since this is only 3 tenants, they may try to request financials from the 2 tenants.
Interesting. Which would
Okay.
be, definitely possible with Carrie's Car Care because, they're going to be the smaller operator of the 3. Caliber, I mean,
It just really depends on what your lease says, because there's a lot of leases that don't
required.
specify or require that financials get put forward.
Exactly.
So if that's the case, and you just basically tell the lender to pound sand. But
Politely.
yeah, it's
Or not.
it's just more of they're going to look at this rent roll and say, okay, I need a clean phase 1. But otherwise, this is probably most likely going to be a bank or credit union deal, mostly because they've got really competitive rates right now, but also because they're just a good fit with regards to the loan size, which is like basically sub 10 million.
Yeah.
And so on that, this is going to be most likely a full recourse loan, unless for some reason we're at like 40% or less, which I mean, we're kind of there now.
Which is what you were saying, over the phone with, recourse becoming, really into play as, what you're seeing in the market right now, just because of how volatile everything is, right?
Yeah, and I mean, as like if I was putting my investor hat on, I'm not necessarily scared of recourse if I do my due diligence on Caliber and Carrie's Car Care.
Exactly.
If they've been here a while and they're doing well, and if they let me peek at their financials and their financials are doing well, I'm okay with it because I don't think they're going to actually, and I get a clean phase 1. I'm trying to just eliminate as much risk from the deal that could come back, that could cause any other like future injections of cash I've got to put in the deal.
Yeah.
Right. That's why a lot of guys or gals and investors really like having those single tenant credit tenant lease deals because they can sit there and they can just obviously click the coupon, but the amount of risk that they have is really low, so they don't necessarily need to worry about that. But that's where an opportunity to come in, you can get good pricing and good deals.
Exactly. Especially with a location like this in Tempe, Caliber Collision on Priest Drive. Even if, say, Caliber left in the future, releasing that building wouldn't be too much of an issue. It's
in replaceable rents too, which is
Exactly.
nice. I mean,
Yeah, they look like they're below market.
what are your thoughts? We see a lot of sale-leasebacks, especially on the industrial side, and they're usually coming in above market. Does that just get, when you guys go to underwrite, it's just going to get written down? It's like, this is
The lender's going to underwrite market rents.
Yeah.
So we've seen that too, where the investors have approached us and said, hey, I've got a chance to do a sale leaseback with this.
Yeah.
What if I have them sign a higher rental lease? Like, can I get more loan proceeds? And it's like, theoretically it sounds great, but it just doesn't work.
Yeah.
The lenders don't care.
Yeah.
Because again, it goes back to, if I took this property back and we had to go out and re-tenant the building, what is that rental rate that I'm going to tenant at?
Yeah.
And that's what they focus on.
Exactly.
And they also focus on, there's like a bunch of factors that the lenders are taking a look at. But with regards to this is really a straightforward deal. As an investor, you're just probably buying this for cash flow if you can get a decent cap rate and your financing's not too bad, you're pretty good.
It's a lot of like the tweener 1031 buyers that are probably going to be, putting down 40-45% from what they're talking about.
Yeah, now in this case, just because the borrowing costs have kind of come up a little bit, your cash flow on this after the debt service is not great.
Yeah.
Based on the purchase price. So for instance, like, you know, you're really barely even clearing, you know, like $75,000 here.
Yeah.
So you're basically taking home 76. It's more than that because you probably have your reimbursables coming in.
Correct.
But if I'm underwriting it and I'm looking at how much I got to put in versus that's what I'm looking at.
Yeah.
So that's kind of some of the hard part that's going on in the market, which makes it difficult to put deals together right now.
Yeah.
So,
Yeah.
I
I know
think-
just from talking with some clients too, they're surprised at how much they have to put into the deal versus they have in previous deals.
Yeah.
Right now they might have to put 45 or 50% down versus in the past that would have been 30%.
mm-hmm. And so that's kind of some of the gap in the market right now, like we mentioned before, which is like the purchase prices just haven't come down to accommodate the rising interest rates fast enough.
Yeah.
Yeah.
And it's tough because in 6 months, I mean, rates have moved so much that it's difficult to wrap your head around it unless you're in that every day.
Looking at this and going back to them with this is how everyone's underwriting it, and this is pretty realistic and conservative. So obviously we've got a discrepancy, you know, to handle with our pricing.
Yeah.
Mm-hmm.
And from our standpoint, it makes sense to approach that sooner rather than later since
Correct.
the selling environment's not getting any better.
No, it's not. So I think you guys have a tough job because you're going to have to have like a real conversation with the buyer and say, where do you really want to sell this? It's not really easy right now. And so this is where you guys are earning your fees just like us.
Exactly.
Exactly. Yeah.
Yeah. So if we have clients that want to hear more about lending and what's going on in the market right now, what could you do to help them?
Really it's just a conversation. So
Okay.
I'll run the same analysis. If there's a buyer out there that's like, hey, I'm interested in this deal, what kind of financing can I get on it? We're just going to run the same analysis and I'm just going to give them my feedback. Obviously,
Yeah.
with regards to the purchase price and stuff, I'm not really going to give them my opinion that much on it.
Yeah. That's
I'm
what
just
we're
gonna
here
tell
for.
them- Yeah.
Yeah.
Because that's all determined by market. So I'm not in that day in and day out like you guys are. That's where you guys come in and can give your opinions and your values and your knowledge base of like, we're in day in, day out, here's
Yeah.
where those purchase prices should kind of be. I'm just going to tell them where they can get financing, what
Yeah.
that financing environment's like. Is it easy? Is it hard? You know, how long is that going to take? And what's good is that, you know, we get paid at close just like you guys do. So everything that
Yeah.
we're giving, any advice, any talks, any phone calls, meetings, all that stuff is all free until we close everything and do the deal.
Exactly.
So it's nice.
Yeah, which I think a lot of people don't understand, even like, you know, for what you're doing too. I mean, we get paid for the work that we've done, not the work that we're going to do. So.
Yeah, and so it's always interesting because, you know, borrowers will say, oh well, I have a bank I do a lot of deals with. And it's like, that's great, that's wonderful.
Yeah.
There are, you know, 150 lenders out there that you probably haven't talked to, that we have access to, that we can go and take a look and structure, that we know a lot of their loan programs in and out, and maybe they can either get some type of either maybe better interest rate or better loan structure or something that could help the deal out. But, you know, it's up to you. If you have a lending relationship and it's an easy loaning process, you know, we'll have that conversation. Sometimes I just tell them, yeah, actually that's a good deal, take it and go with that. And then if you need anything else, we can go back out to the market and we can try to find some other stuff for you.
It's like
Yeah.
second opinion. I mean, there's no harm in it.
Yeah, and so
It's fine.
yeah, it's definitely an interesting time to be in commercial real estate right now.
Yeah.
I agree.
But I mean, like you said, it's, you know, where we earn our fee, and I think, you know, we talk about this all the time, like the comparison between guys who are out earning their fee and then there's the order takers,
Mhm.
where it's like, are they even going to be here in 6 months? I mean, we'll find out.
Yeah.
So,
And that's how you get clients to come back to you too. Obviously, you want to make sure that they're getting a great deal.
Yeah.
They're not entering into a deal that's going to be a negative rate of return or something that could be very risky in a couple of years if their tenant leaves.
yeah.
And so that's what we want to do is obviously make sure that they're they're underwriting it properly to where they can make some money.
Yeah, I mean, we're basically, you know, if you want to break it down, we're consultants, right?
Yeah.
They're coming to us for our knowledge on what's going on to be able to help guide them. And that's what they're paying for, is to be able to make sure that they're getting the best deal that they can possibly get at that time.
Yeah.
So, yeah, I mean, I guess kind of in summary, I like this deal. I think we've already mentioned that. It's
We
just,
said that from day one. Like, why don't we buy it?
Yeah.
I'm just kidding.
Yeah.
but like a lot of investors, it's always at like what price? And that's kind of the problem right now, is that the pricing today, it's going to be less going forward. And I don't know if investors can wrap their minds around that yet,
Yeah.
or especially sellers.
At the same time, when you look at where these values were a year ago, 2 years ago, and rents have gone up, 15 to 20% in a lot of the submarkets, you're still at a massive win over where you were just a couple of years ago.
I mean, there's definitely multifamily deals that we've looked at that people have bought, call it 14, 15, where their value is like triple.
Yeah.
And they're trying to sell,
Yeah.
doubles or triples, and they're like, oh, we don't want to take anything less. And I'm like, okay.
Yeah.
Well, you should.
Yeah, you should definitely, if you're gonna sell, like, take whatever the discount it is today to sell. So I mean, you guys are in a tough spot, because if you're trying to win a listing, you obviously want to say, hey, we're gonna be able to sell for this really good price.
Yeah.
But you also have to kind of be realistic of like where you actually think it's gonna sell,
Yeah.
and can you communicate that to the seller well while also getting that listing? Because if someone else is gonna come in, unfortunately in commercial real estate, there's not a lot of great commercial real estate brokers in terms of, they're just going to tell a price to try to get a listing.
Right.
And you have to compete against that, so it's tough.
Yeah.
Yeah. But at the same time, you definitely have to be realistic, because if you have that realistic conversation with the seller in 3 months from now, the price slash is going to be much greater than it would have been now.
Yeah. So I mean, it's kind of a thing of like building their trust of like, look, maybe 5 months ago we could have gotten this, but now not so much. So
Yeah, and so it's tough, because sellers and people that are not necessarily in commercial real estate, they're, the trust factor is really tough to establish.
yeah. I guess the only thing we didn't cover, what is your background in CRE? Obviously you worked on RE's team. I think, was that right out of college?
Yeah, so I started out in brokerage back in like 08, and I was basically in for started out as a runner. Was there for
Yeah.
6 months, and then financial crisis hit. I wasn't able to get back into commercial real estate until about 2010, and then I got back on the brokerage side, the land side, and we sold land to home builders and investors and developers.
Yeah.
And then I got more pulled in towards on the financing side, and I've just been doing conventional SBA and different types of loans ever since.
Yeah. So how long have you been at CBRE?
So I've been at CBRE since March, but I've been on the lending side for 9, almost 10 years now.
Okay.
So
Yeah.
seen a lot of different deals, looked at a lot of different stuff, and I mean, it's just learning every day. There's always stuff to learn in our gig, which is nice.
Yeah.
But yeah, it's CRE is very interesting when you start running through and looking at it and going through, and it's a tough gig. Like, your job requires you to have sales skills. You need to be able to be a little bit of an economist. You have to have financial analyst skills.
Yeah.
You have to be able to do all these things somewhat well in order to kind of get deals done and be really good at this job. It's tough.
Yeah, definitely have to wear a lot of hats, and
Yep.
sometimes more of one hat than the other, depending on the market and who you're working with.
Yeah, and these days,
It's interesting.
more of like a psychologist too.
Therapist,
Yeah.
psychologist, it's all the issues.
Yeah.
I guess what would be your advice for like someone who's just getting into commercial real estate or just looking?
I would say right now is probably a good time. And I know that sounds weird, just because
Yeah.
we're going into a little bit of a dip. But right now, in these times, it's where the really good brokers really separate themselves. where it's you
Yeah.
can focus on. It all comes down to the fundamentals of being able to look at deals, evaluate the market, and so kind of running through like the analysis that we did right there. You know, if you can run that and do that and walk through the borrower, or for me the borrower, but for you guys, you're the buyer, the seller, and be able to kind of keep doing that process over and over again. Your knowledge base and everything else is going to be there, is going to be building, and then you'll also have the chance to, when the market does correct, hopefully you've been able to establish yourself, and you can kind of just shoot off from there and reap the benefits of being in a really good market.
Yeah. Exactly. And for an investor who's looking to invest in their first deal, or maybe they're newer to the game,
Yeah.
would you recommend that they move forward on a deal now or hold off until prices come down a little bit? At what point do you think it makes sense to jump in?
I mean, I think
It's tough.
Yeah, it's
Yeah.
tough. Like if you're an investor and you want to invest in real estate long term, then you just get in when you can.
Yeah.
And so if you can get decent value with something, let's say for this deal right now, I end up getting this deal at like a 7 cap, and the market changes and this becomes like an 8 to 9 cap. I don't care, right? I'm buying it for a certain cash flow.
Yeah.
And I know eventually that's going to flip. That's going to
Exactly.
move if I'm holding this for a while. And so it really just depends on what type of investor. If you're trying to get in to be able to try to flip deals, then you're in a tough spot, because you're going to have to wait until that the values are going to come down a little bit more, but your interest rates are going to go up. So you have to try to time that, which is very difficult to do. No one's going to be able to do that.
It's almost impossible
Yeah.
to time the market.
But if you're just a real estate investor that's going to hold, then I'd be kind of trying to get in right now to take a look, see what's going on, start establishing relationships, learning the markets, figuring out what kind of deal you want. And if you can get decent deals right now with a decent spread between your interest rate and your cap rate, you're probably going to do pretty well.
Right.
Nice.
Yeah. If you can find a deal that cash flows and makes you the return that you're looking for, there's no sense waiting for a better market, because no one knows when that's going to be.
Yeah, and so like you're saying, if you can pencil the deal right now when you buy it and you get your returns, I'm not necessarily cared about if those cap rates go down even more, or the value drops a little bit, because I'm still getting my returns.
Correct.
Yeah. That's
So-
when you can buy your next deal.
Yeah. And so that's just I guess that's my response. Any other questions or anything?
I think that's it. I mean, thank you so much for coming
Thanks
in.
for coming
It was
in.
Awesome.
Super helpful. Always good to hear someone else's take on things, obviously, with being on a slightly different side of the business too.
Yeah.
Yeah, it's our business. It's very relationship driven, and so I know I'm at CB, but
Well, it's funny because I remember this was even before Churchill days, when we just randomly grabbed coffee, and it's how many times have we just I've thrown stuff your way, we just go back and forth, and going back to relationships.
Yeah.
I mean, I've probably known you since I started 7 years ago.
Yeah, and for me, if I talk to different investors around and they're like, hey, we're looking for a broker that's going to be able to kind of help us buy this deal,
Yeah.
I'm saying, hey, look at Levros, or look at, we've got great guys over at CB. It really just depends on what
Yeah.
they're trying to do and who they want. But we usually try to refer business back and forth, because it's all about just trying to get deals done. And so if you get deals done and you execute, the rest kind of takes care of itself.
Exactly.
No, be a good person, don't be a dick. So
I hope that's not us. I'm just kidding.
no, you guys are fine. But there's definitely people that start getting attitudes, and that's something that just makes it more difficult to get deals done.
Makes sense.
Yeah.
Too big for the britches.
Yeah.
Well, perfect.
Yeah.
Yeah.
Thanks so much.
Yeah.
Appreciate it.
Cool.